Hello everyone. This is Bruce Westra with WealthBuilder LLC and Courtney Smith presenting another episode of Basics with Bruce. Tonight will be short and sweet. We are going to be talking about basic order types, and there we go to start. So basic order types. But before we get started, I wanted to let you know about a program that we have at WealthBuilder. It's a mentoring program, and it's available to give one-on-one coaching for new traders. You don't have to be a new trader for you to benefit from the mentoring, but I suspect that many of you listening tonight are new traders and would really enjoy and benefit tremendously from one-on-one mentoring. If you're interested at all in mentoring, learning more about it, just send me an email at brucew@wealthbuilderllc.com. And if you would include your phone number, we'll get back with you and give you some information about the mentoring program. All right, well, let's get started. So, basic order types. As usual, we start with the disclaimer because the government wants us to know these things, and therefore we should carefully note the disclaimer. So we're going to start with market orders. So market orders, a market order is an order to buy or sell a specific number of shares at a price close to the current market price. So you can use market orders to buy or sell with a market order, either a buy market order or a sell market order. So once your order is placed, the order will then be filled at the next best available price, at or around the stock's current price. So it's simple and fast. Let's say you place a market order to buy 100 shares of DDD. So with a market order. So your broker will now purchase 100 shares of DDD at the next best available price. And let's say that DDD is trading around, let's say it's $38. You place the market order, your broker purchases 100 shares at the closest available price. That price may be $38.05, $38.07, right around $38. Usually it's going to be, if it slips at all, because that's known as slippage. The slippage is the difference between your order price, which was $38, and the fill price, which was $38.05 or $38.07. That's known as slippage. The main benefit of a market order is that your order is almost 100% guaranteed to get you into a trade. The disadvantage of a market order is that you're not guaranteed that the fill price is going to be the same as your order price, especially if you're trading in a volatile market. So be aware that there may be some slippage with market orders, or any order for that matter, if you're trading in a volatile market. So you can use it to exit also. For example, if you made a mistake and you got into a trade by mistake and you wanted to get out right now, you could exit with a market sell order. And you would want to do that as soon as you discovered you had made a mistake. Remember that Courtney says that 80% of mistakes will end up hurting you. 20% of the time you may come out even or possibly gain, but 80% of the time they're going to hurt you. So my advice would be to exit with a market order for the correct amount of shares as soon as you discovered that you had made a mistake and were in a trade incorrectly. Excuse me. So market orders. There's another use for market orders. And let's suppose you are going to be putting on an inside day trade. But first, let me explain what an inside day is for those of you who don't know that. An inside day, on this chart that I have here, an inside day is the very last bar to the far right. And you'd notice that the high of the last bar on the chart is lower than the bar to the left of it. You see that the high of the last bar on the right is lower than the high one bar to the left. And you also notice that the low on the last bar to the right is higher than the low one bar to the left. That's the definition of an inside day. That's how you would find inside days if you were looking for them, by looking for a bar that was totally within the high and low of the previous day. The other way that you could tell on this chart is, do you see that little black dot above the last bar on the chart? That's a inside day dot that we can program on our Pro Real-Time charts. So those are two ways that you could find an inside day. But let's just say that you were wanting to enter the trade in heating oil. If the price broke below the low of the last bar on the chart, and you'll see the closing price, that's the little marker that sticks out on the right side of the bar. The little marker that sticks out on the left side of the bar is the open price for that day, and the little stick out on the right side of the bar is the close price. Now, in this example, obviously it's static, and that close price is not moving around at all. However, in real life, that little close indicator could be moving up and down, 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 and you want it to be in this trade to the short side. And you were afraid that if you took the time to put a normal buy stop order or a sell stop order in, that the trade would be gone. You'd miss it. You'd miss your entry. What you could do is put a sell market order in, and that would get you in the trade at a price that was very close to the price that you wanted to get into it with. So that's another use for a market order. It's a fast way to get into a trade if you were worried that the trade was going to get away from you. In other words, go past your entry point, and you'd be unable to get into the trade because then you'd be chasing it. So you could use a market order to quickly enter the trade. So that's another use for market orders. Now we want to talk about stop orders. So stop orders are orders to buy a stock. In fact, we want to talk about, well, let me summarize stop orders first. We have buy stop orders, which are used to enter long positions in stocks, futures, and Forex. A buy stop order would be used to exit a short position for futures and Forex as a stop loss, or when we move the stop loss, if the trade is going our way, we move our stop loss to protect our profits. So we use it to protect against losses, and we use it to protect our profits. So those are buy stop orders. Sell stop orders I use to exit long position in stocks, futures, and Forex as a stop loss or to protect profit. And they're also used to enter short positions in futures and Forex. So those are buy stop orders and sell stop orders. Then we have sell short stop orders. Try to say that 3 times fast. Sell short stop orders. They're used to enter short stock positions. Buy to cover stop orders are used to exit short stock positions as a stop loss and again to protect profit. So you will want to review these stop orders. Don't try to say them fast, just review them carefully. So good. So let's start with buy stop orders on a real chart. Now remember that a buy stop order is an order to buy a stock at a price above the current market price. Now once the stock's price trades at or above the price you specified, it now becomes a market order. So that's why I started with market orders before, so that you would know that when a market order goes in, it's guaranteed to be filled almost 100%, but there may be some slippage. So a buy stop order changes to a market order as soon as the price that you specify is touched. Then it changes to a market order and you're in the trade. And it's used, in this case, to enter a long order in a Lexan. Let's say that you felt that if the price went above 178, you wanted to be in that because you felt the price would continue up. So you would place a buy stop order at 178. When the price traded up there and touched that, then it would change to a market order. You'd get filled and you'd be in a long position. Now I'm just going to assume when we talk prices that the buffers have been added in. Normally, of course, you would add your buffers on to the prices, but just to make it easy for me, we're going to assume that we have added the buffers in, if that'd be okay with you guys. All right, so now we're in a long position with a buy stop order at 178. So now we said we use sell stop orders as a way to protect us from a big loss or to protect profits. So what we do in this case is we would feel that if the price traded below 88.86, then it would probably keep going and we would incur a huge loss. So we would sell or place a sell stop order at 88.86 to protect against a larger loss. And if the trade continued on in our favor, we would move that sell stop order up until we were in a profitable position and protecting our profits. So Jane is asking me to go back one, and that is that screen for you, Jane. That's where we would put a buy stop order in at 100.78. We would place our sell stop order at 88.86. So I'll review the different orders at the very end, so don't worry about that right now, but just kind of get the concept of using stop orders. So the main benefit of a buy stop orders is that you will only purchase the stock if the price is showing upward momentum. So that's why you use buy stop orders, and you would use a sell stop order if you felt that you were you'd place the order at a place where if it passed that, in this case 88.86, if it passed that to the short side, it would be showing downward momentum, and you would no longer want to be in your long position. So one of the main rules of trading is never trade without a stop loss. So in this case, we're showing a sell stop order used as a stop loss order, and then you could eventually use it as a way to protect your profits as the trade went in your favor by moving the stop loss in the direction of the trade. So here's another trading principle for you. Why we use stop loss orders is that the first loss is always the smallest loss. It has to do with the trading principle that Courtney talks about of cutting your losses and letting your profits run. Does that make sense? Good deal. Now we want to talk about stocks, particularly using sell short stop orders. And in this case, if you remember, we talked about shorting last week, and these are the order types that we use to sell short stocks. A sell short stop order is an order to sell short a stock at a price below the current market price. So once a stock's price trades at or below the price that you've chosen, it then becomes a market order to sell short. And we know that market orders pretty much guarantee us that we're going to be filled. So note that it's very similar to a sell stop order. The only difference is that a sell short stop order is used to enter a new short position, and a sell stop order is used to exit an existing long position. So as an example, suppose we want to sell short 100 shares of this stock, which is SDOW, which is an ultra short Dow 30. And if the price falls below 45.12, so we place our sell short stop order at 45.12. When the price touches that level that we've specified, it then changes from a sell short stop order to a sell market order, and then we're in the trade. So remember that the benefit of a sell short stop order is that you only sell short if the price is showing downward momentum. In other words, it's a breakout in the direction that you want to go. So sell short stop orders are used for entering new short positions in stock that break below a level of support. So remember, once your stop price is reached, your order becomes a market order to sell short, and you may be filled at a price a little bit different from your order price. And it's usually just a little bit, but it depends on volatility. If you get a huge amount of slippage, you would want to contact your broker and ask him why you had such a bad fill, and ask if other trades were filled poorly also. And sometimes you can get them to cut your break, sometimes you can't. All right, so that is the sell short stop order. The buy to cover stop order. A buy to cover stop order is used to exit a short position as a stop loss or a way to protect your profits. So a buy to cover stop order is in order to cover or repurchase the shares you've borrowed at a price above the current market price. So once the stock price trades at or above the price you specified, it becomes a market order to buy to cover. So in other words, if you are in a short trade, you place a buy to cover stop order as your protective stop loss. And in this case, let's say we're in this trade short, and we put our protective stop at 49.61. So if S-Dow trades up to 49.61, your order becomes a market order to buy or cover, and then you would be out at the next available price. That's the worst case scenario. The best case scenario is that the price moves down, and then we move our buy to cover stop order down in the direction of the trade to protect our profits. So we're covered with these stop orders in the case of a worst case scenario or in the case of a best case scenario when the price moves in our direction. The worst case scenario is we get out with a small loss. The best case scenario is we get out with a huge profit. So remember last week we talked about how some people classify selling short as risky. Well, I just wanted to point out to you that if you were in this trade short, the most amount of profit that you could get would be $45.12 per share. So your profit would be limited. But if you didn't have a stop loss, your potential for loss would be infinite. And that's why, because the price could go from $45.12 up to $80 or higher. So that's why this selling short is classified as a risky trade. But using the methods that Courtney teaches, you're not going to be in that position if you follow the rules. So I hope that makes sense to everyone, because we're protected if we follow the rules. However, we're out in the wind, so to speak, if we don't follow the rules. So to summarize, for stocks, we use buy, stop, and sell stop orders. We use sell short stop orders, and we use buy to cover stop orders. So those are all the orders, stop orders for stocks. For futures and forex, we use buy and sell stop orders. The difference is, remember, for stocks, when we go short, we have to borrow those shares, and then we have to buy them back later and return them to the broker. But for futures and forex, we don't have to borrow anything. We just buy and sell. So it's a little more straightforward with futures and forex, but the principle is exactly the same. And remember that if you wanted to review this, you would go to YouTube and search for Basics with Bruce, and this will be posted on YouTube also, so you can easily go back and review again. So modifying orders. When we have stop orders, we want to modify them. The two kind of modifiers are good till cancel orders, which are commonly known as GTC, good till cancel. A good till cancel order is an order that will be, once you place it on the platform, it will remain there until you manually remove it or until it's filled. A day order is an order that when it's placed on the platform is only good for the trading day that you place it in. So why is this distinction important? Well, let's say you put a buy stop order in as a day order for copper. And for the day that it was in, copper stayed below your entry price. At the end of the day, your copper trade order, buy stop order, would be canceled by the brokerage platform. So you wouldn't have a buy stop order in. Then that would be the day that the next day that copper would break out and you wouldn't be in the trade. However, if you had used a good till cancel order on the day that you placed the order, the next day that copper broke out, your order would still be there and now you're in the copper breakout trade. So it's important to remember that if you want that order to be there longer than one day, that you use a good till cancel order. Does that make sense to everyone? Very good. So next week, we're going to talk about limit orders and the difference between stop orders and limit orders. We're also going to look at trailing orders. That will be a fun exercise, and I'm looking forward to it. So remember that stop orders are orders that when the price that you specify is touched or traded above, they turn into market orders and you're guaranteed to be filled. Next week we'll talk about limit orders and how that doesn't apply to limit orders. So good. All right, so let me see. Questions. We can go over some questions now. So let me see here. What are the peach-colored lines on the chart? Pat, those lines are for, it's an indicator for, those are called Keltner channels, and they're used for the trading technique. Oh man, I'm drawing a blank now. I'm so embarrassed, you guys. If somebody knows, help me out here, but it's called, crap, the more I try to remember it, I can't remember it. Hopefully, as I put it in the back of my mind, it'll come to me. But it's an indicator for it's bandwidth. That's right. Thank you, guys. Thank you, thank you, thank you, thank you, thank you, thank you. Howard, thank you. Inad, thank you. Oscar, thank you. Frank, thank you. You guys are so smart. We have the smartest students in the whole world. All right, so let me see. Slippage, yeah, sometimes you're going to have slippage, and there's not much you can do about it unless you have big slippage, in which case you can talk to your broker. When selling short, would we use the opposite strategy of the best of the best in finding stocks? Yes, we don't want to short or sell short the best of the best. So we can use other methods for finding stocks that we want to short. We would want to sell short stocks that are trending downwards. We can also use ETFs to sell short. Yes, that's perfectly fine. ETFs trade just like stocks, so we can use them to short also. Nick asks, what's the derivation of the terms long and short? What is a long or a short? A long is when you enter a trade with a buy order that's said to be going long. A short is when you enter with a sell order, either a buy sell or a sell short order. So long is when you buy and short is when you sell. All right, everybody, that's all I have for this week. Remember to send me an email if you're interested in mentoring with your phone number on it, and we'll give you some information. That's all for this week. Happy trading.